Welcome everyone to the first episode of How to Make Money in Stocks with Investors Business Daily of 2016. Looking forward to a great year.
And may it be a good year for all of the investors out there.
Absolutely. We're recording earlier than the show will be seen, so Happy New Year. Hope you had a great Happy New Year, which already occurred. And we're going to run some shows that we've run in the past.
The best of.
The best of.
The best of Matt and Amy.
Yes.
Okay. So we're going to cover some stock simulations that we think you will find very valuable. You know, would you buy this stock? It's kind of interesting to go through that and ask yourself those questions. We're also going to go through some of Bill O'Neill, chairman and founder of IBD, some of his big monster winners.
Right. So let's just jump right in. So now it's time for a little simulation.
Have a little fun here.
That's right. Let's play a round of would you buy this stock? And our participant this week is a mystery stock. We'll tell you later.
All right, this had been a really hot IPO, and several IBD investors might have made some nice gains in this stock. So this is a weekly chart of our mystery stock, and you can see that the IPO base was there. Then it ran up more than 93% before pulling back.
And boy, it really pulled back.
It really
came down. It fell from a high of around 98 to a low of 37. But then it found its footing and it started to bounce back. And then it formed this cup-shaped base in July.
And before the breakout, this stock had seen several tight areas as it recovered from the sell-off. So this was very constructive behavior. Now this stock broke out the week of July 24th.
So the question you ask now is, would you buy this stock? Now, before you answer, let's also note that the market was in an uptrend at that time, as noted in the market pulse. There were 5 distribution days on the S&P and 4 on the NASDAQ. These are days of heavy institutional selling. That's not too high a count, but it is definitely something to watch. And this company had just reported Q2 numbers, and earnings growth spiked to 250%, and revenue was up 72%.
Now, this is where you ask yourself, are you buying the stock right here? We will come back later with the answer. Now, we hope that's been a fun little learning segment. So did you decide whether you would have bought the mystery stock? And by the way, the mystery stock is GoPro.
That's right. So let's do a quick recap of what we talked about earlier and see where GoPro stood at the time. It was just clearing a buy point in this cup-shaped base. The market was in an uptrend, and GoPro had just reported very strong Q2 earnings. It showed another quarter of triple-digit growth. So now the question is, would you jump in at this point?
All right, this is a daily chart of GoPro, and here we are, July 22nd. This is when the stock broke out. Volume was 311% above average. Now, the day before the breakout, volume was up 173%. This is exactly the type of institutional quality buying that you want to see. So if you decided to buy right here, this high volume really looked pretty good.
Right, so let's go back to the weekly chart for a minute, and this shows the concept of overhead supply. Many people who bought back here and they are now sitting on a loss, they're tempted to sell when the stock rises, gets a little bit closer to their break-even point so that they can recoup some of those losses. Now, that makes it hard for a stock to advance, and GoPro had a lot of overhead supply at this time.
Okay, so did you buy? And if so, do you have a plan in place? Where might you have taken some profits, or do you have a solid sell plan in place in case the breakout doesn't work? And of course, in the case of GoPro, you needed to have a selling plan. It turns out that you needed one because soon after the breakout, the stock began selling off.
So GoPro tried to hang in there for a couple of weeks after that breakout, but like you said, it started to roll over. And interestingly, the general market was also starting to roll over at that time. On July 24th, just 3-4 days after GoPro had broken out, the outlook changed from confirmed uptrend to uptrend under pressure. So that is a sign to be extra cautious and ready to reduce your exposure if the stocks you own start to sell off.
Now, the black squiggly line is the S&P, and you can see that it began pulling back. So what happened to GoPro? Well, it did exactly the same thing. Remember, most stocks are going to follow the general market trend, and volume began picking up, showing that the pros were heading for the exits.
So you could have bought GoPro. That's a completely legitimate buy on that breakout. It had good volume, strong sales and earnings growth, and the market was in an uptrend at that time. But things can change, so you have to be flexible. On a dime. Have to be flexible.
And this happens sometimes. Look, a stock will break out, volume looks good, but the market changes directions and the pros sell. So we hope this has been an instructional and kind of a fun little exercise for how important it is to have a plan in place. We have offensive selling. This is the fun part. We take profits, and then we have defensive selling, protecting your portfolio from big losses.
Both are critical.
Yes.
You have to have both sides of the selling
Offensive
equation.
and defensive selling.
That's right.
Would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
So what did you decide? How are you going to handle Facebook going into earnings? First of all, let's talk about the overall market. Now, we were under pressure at the time. We had 7 distribution days, and since most stocks follow the overall trend, Facebook had also pulled back some.
Right, so the week before earnings were due January 29th, 2014. Facebook pulled back and was a bit below the buy point in this most recent base, but it was still above the 10-week line, and volume was well below average, so it didn't look like the selling was particularly aggressive. And it was obviously much lower than the volume in these prior up weeks. So if you had bought in this most recent breakout, would you hold through earnings?
Okay, do you want my answer?
Sure.
Got my answer? Nope. Because the market was a little shaky here. We had elevated distribution days in the market, and you're sitting on a small loss. You combine all those things together, I would jettison and then buy Facebook back if it reported well. I've also heard Mike Webster and Charles Harris, the portfolio managers for Bill, who's the chairman and the founder of IBD, say that that's basically the way they would handle a stock also.
And nothing's set in stone. It really depends on different factors, your own personal risk
Your level
tolerance,
of conviction.
Your level of conviction,
Okay.
Absolutely. Now, another option in that scenario would be to sell a portion of your position that reduces your risk and reduces your exposure, but you'd still have, say, let's say 50% of your position. So if the stock does report well and takes off, you benefit from that. So again, this is a personal decision, and it depends on many different things, not the least of which is how much of your portfolio, how much of your money is in that one stock.
And where are you in the life cycle of a stock? You know, stocks have different life cycles, and Facebook was kind of a newer IPO, so it was younger in its run. You know, or you could really roll the dice and you could have had all your money in it. That's a little bit more risky. Sure. So let's just say you bought Facebook out of the double bottom base back in July. Now, if that's the case, you would have been sitting on a pretty nice gain, as we mentioned before. So holding going into earnings really becomes a whole different ballgame.
So let's switch to the daily chart, and you can see what happened the following week in the lead up to the January 29th after the close report. So you're looking at January 29th, but it still hadn't reported. So 2 days earlier, Facebook had fallen below the 50-day line, but came back and closed above it. And it didn't quite trigger that 7% sell rule when it dropped that day, but it came very close. It fell about 5%, a little over 5%. So again, If this is really happening with your money on the line at this time, are you getting out or are you sitting
tight? Now, a positive here is that Facebook found support at the 50-day line, which was good to see. Volume and price action the day before Facebook reported were not positive, though. Volume rose 56% and the stock tumbled 3%, and it did close in the bottom of the range for the day.
And in the scenario where you bought on this breakout, you had a loss going into that earnings report. But if you bought back in July, you'd still have a gain of somewhere around 60% or so, depending on where you bought. So that gives you a lot more leeway. But you still want to have a defensive plan in place, even if you're sitting on that big gain. And maybe locking in some of those profits ahead of time is one option.
Hey, locking in some profits anytime can give you a little psychological boost. So if you are in a completely different place and you're sitting on a nice gain, that's completely different. The point is, you want to do this exercise with as many leaders as you can. Just go back in the past. Ask yourself honestly, sort of day by day, how you would have handled them.
Right. Now, Facebook did end up reporting well, and it bolted higher. It gapped up to close 14% higher for the day. So holding, of course, was the right decision, right?
Yeah.
Well, in
Easy
hindsight,
to say,
of course it was in hindsight. But when you're sitting there waiting for it to happen, it's your money on the line.
It's totally different.
Very different situation. So it definitely could have gone either way. And that's why you really do need to have a plan that you can live with whichever way the stock goes.
That's right. And that is, you have to have a plan in the market. It really helps you out. That way you're not flying by the seat of your pants in the moment.
Or sweating it out every night.
Sweating it, absolutely. And you want to be able to sleep at night. Now, Facebook showed the same kind of behavior in this most recent earnings cycle. It broke out ahead of earnings, and if you bought it out of that base, you wouldn't have been sitting on much, maybe like a 7% gain from the 96.59 buy point. And that's a little bit of a cushion. So again, are you holding, are you selling, or are you all in right before earnings?
Right. And this was Facebook on November 4th when it was set to report after the close. Again, if you're playing along with this in real time and it is your money on the line, think how important it is to have that plan in place. And again, it has to be something that you can live with. I go back to what Lee Tanner, who's the organizer of the Petaluma IBD meetup group, said on our show when we interviewed him, was that if he's really fretting, really worried about how this stock is going to report, he'll just get out because it's not worth the risk.
That's right. Now, Facebook gapped up November the 5th after reporting, although there was a little bit of stealth selling going into that breakout since the stock closed in sort of the mid to lower part of the range for the day. But on Friday the 13th, it took a rather nasty little pullback, although it did get support at the 21-day line. And then, of course, it did bounce a little bit from there.
Right. Then on Monday, it fell during the day, but it rebounded nicely to close at the top of the range. And note the volume. It was 70% above average. That tells you that some big investors were stepping in to buy. And also note how that support came in above the buy point. That's another positive sign.
So we hope you've enjoyed Would You Sell This Stock? It's a good exercise to do with some big winners to see how you might have handled them. It's time for a super stock review. It's helpful to remind ourselves as investors that the market will get easier and giant gains are possible in the market. Now, nothing really changes in the market. This is a famous Bill O'Neill statement. He is the founder of IBD. So it's good to review these big winners from the past so we can find them in the future.
That's right. Now, to find a winning stock, you have to know what one looks like. And to find out what they do look like, start by studying these past winners. So today we're going to take a look at 3 super stocks to show really how similar they are.
Now, one stock we're going to take a look at is McDonald's. In the early 1950s, the fast food franchisor was serving up 15-cent hamburgers, imagine that, Matt, and 8-cent French fries.
I'd be in bad shape if they were still
15 cents. McDonald's was the driving force behind the whole fast food phenomenon.
Right, and franchising as well. The point is that McDonald's was revolutionizing an industry that was at the forefront of this car culture zeitgeist and the rise of just a faster paced way of life in America. And companies leading major trends like that are the ones that tend to go on and become these super stocks.
Now, this is a story that was taken from an article written by Bill called How to Find and Own America's Greatest Opportunities. And one of the first things that Bill points out is that the stocks form their bases when the market is correcting.
And here's what that looked like for McDonald's on the weekly chart at that time. This is December
1970.
December 1970, that's right. So here's the cup with handle that it formed, and as Amy noted, it formed it while the market was in a correction. And you can see that by looking at the index line for the S&P.
And it's important to embrace corrections. Matt, I like them now. I used to really didn't understand that. I mean, we don't like them, we don't love them, but
they have a purpose.
But they have a purpose because you get these stocks setting up. They lead to good things. The super stocks or our model book stocks that we have that the portfolio managers have made that we study here at O'Neill always have that something unique that is in mass demand by the public. And what you're going to see is just the very beginning of a massive move.
And when a new market rally began, the correction ended, a new uptrend began, that's when McDonald's started to really take off. And over the next year and a half, the burger giant rose around 320%. And note how it did that with tight trading, good support right along the 10-week line.
And let's take a look at that first pullback to the 10-week line, which is a place where you could add to your position or you could initiate one if you missed the initial breakout. And then it rose an incredible 16 weeks in a row. What's Bill saying? That's not your Aunt Sue in there buying stocks.
It's not, and it gets even better. It was actually up, including those 16 weeks, it was up 22 out of 24 weeks.
That's just huge. Look at the blue. Blue week after week after week after week.
That's right. And then just look at the down weeks too. It really didn't give back a lot during those down weeks. They were just marginally lower. And look at the volume. Those big spikes in weekly volume are a clear sign that some big institutional investors were scooping up shares.
So McDonald's is a classic monster winner. You get a few of these in your portfolio and it can be a game changer. So each time you're wondering what a stock's potential is, ask yourself how truly unique the company is. And does it have a product or a service that's in big demand? We look for those huge earnings and those huge sales numbers.
That's right. Now another super stock that Bill wrote about was Microsoft. Again, these big winners share similar traits. Innovative, revolutionary products that are leading a major industry trend. They also have exceptional earnings growth, and they're likely forming a new base as the market corrects.
Now, this is a chart of Microsoft from 1991, and it has a similar base to McDonald's, which was formed when the overall market was correcting. But these bases can be great launching pads for companies that are doing something truly innovative.
Right now, Macintosh Apple lovers may disagree, but Microsoft was an innovative company in its own way, and Windows 3.0 had come out just less than a year earlier to this part in the chart.
And you have to remember, this was huge at the time.
Oh,
so
absolutely.
go back, this was enormous.
And Microsoft, to this day, still does have the dominant operating system. And this is at a time when the PC sales were really taking off. And of course, Microsoft's stock took off as well.
Yes, it did. So here we are. Let's take a look at the weekly chart. From the breakout until it flashed a sell signal, Microsoft ran up 159%. These types of gains are exciting. Now, once again, we saw huge spikes in volume, showing the professional buying that was going into the stock. And volume really does show whether a stock's being heavily bought.
Absolutely.
Or, it's something that I look at all the time when I'm evaluating a stock.
It tells you that story. Are the funds heavily buying or heavily selling? You can see it right there. Now, around the same time in the early 90s, another super stock emerged, and that was Costco. Again, think about the similarities between McDonald's, Microsoft, and countless other winners. Costco was growing fast. It was revolutionizing the retail industry with that big box format and the club membership, and it was forming a new base during a market correction.
So here we are. Here's Costco. Here's our weekly chart, 1992. It breaks out of that base after the market issues in a follow-through day, January the 23rd. This is 1991, and it begins to make a massive move. This stock also hugged the 10-week line. We love those 10-week huggers. Hug the line.
Makes it easy to hold,
Yeah,
much easier.
I like huggers. Okay, so look at the number of blue weeks versus the number of red or selling weeks. And even those weeks of selling, just like we saw in McDonald's, the stock really didn't give up very much in gains. If you take a look at these three side by side, Matt, they really have a lot in common.
An
awful
common.
lot.
And that's why we study them. The whole purpose of this is so that you know what to look for when you're trying to find that next crop of winners. And a good hunting ground is to check the lists in IBD, like the IBD 50 and other screens.
And the IPO screens, yeah, all of those, the newer issues.
Sure.
So for more chart examples of super stocks, look at the How to Make Money in Stocks written by Bill O'Neill, the book. The first 100 pages are charts in the very front of How to Make Money in Stocks, written by Bill O'Neill. This will give you several other stocks to study that went on and made monster moves.
And it really does reinforce how things don't change.
No,
Because
they
these go
don't.
back over 100
They don't.
years, I believe, right? These 100
Yes.
charts. So we'll have a PDF that you can download of the McDonald's article by Bill on our site at investors.com/investing show. So before we wrap up, we want to encourage you to check out the New Year special issue of IBD, which is the January 4th issue. Takes a look at some things that happened in 2015 and also what to look
takes a
out
look
for in 2016.
16. It's always a very interesting issue, so we hope you take a look at it. All right, we'll see you next week, everybody.